Good morning, everyone, and welcome to the 30th Annual Barron Investment Conference. This is the very first session of the day, so thank you for you early birds for coming to the 8 o'clock session. We really do appreciate it. This morning, our panel is about large cap, global, high growth, and I'm with portfolio managers Mike Lippert, Alex Umansky, and Ashim Mehra. My name's Frank Maiorano, and I head up the family office, registered investment advisor, and trust business at Barron Capital. This panel is designed to get as many of your questions as possible. So we have an audience here, and we have a couple of mic runners, which it's a little hard to see from here. But when you have a question, if you would just raise your hand high, the mic runner will come over to you. We're streaming, so we just want to make sure that the audience gets to hear the question, and the portfolio managers do as well. I'm very proud to say that I have over 76 wise years of investment experience on the panel with me today. And if I could have all the portfolio managers introduce themselves, and what we're going to do after they introduce themselves, we're going to go straight to questions, and I did get some questions prior, so I'll sprinkle some of those in as well. But if we can go ahead and, Mike, if we can start to you introduce yourself and the funds that you manage.
Good morning, everyone. I'm Mike Lippert. Believe it or not, I've been at Barron Capital now for 22 years. I manage the Barron Opportunity Fund. I co-manage the Barron Technology Fund with my buddy Ashim Mehra. I also serve as our head of technology research, and I look forward to your questions this morning.
Good morning, everyone. My name is Ashim Mehra. I co-manage the Barron Technology Fund with Mike. I also manage the Barron Innovators Fund, and I've been at Barron for 12 years.
And Alex?
Good morning. I'm Alex Umansky. I manage the Barron Global Advantage Fund, the Barron Fifth Avenue Fund, and the Barron Durable Advantage Fund. This is my 15th Barron Investment Conference. This is actually the 13th time that I'm presenting, and I've been with the firm for 12 years. Those of you who can figure that out, we have a Tesla outside, but one, so that's a joke, by the way. Yeah.
Perfect, so thank you very much. So if I can see in the audience if we have any questions to start things off. Any questions?
Right down here in the middle.
Good morning. This is to Alex. Alex, you've done a great job this year on Barron Durable and as well as Fifth Avenue. But they both are up year to date, 32 and 34% respectively. Why is it Morningstar has a 5 on your first one and a 1 on your second one? That just baffles me. Any ideas?
So it's probably better to ask Morningstar. How they do it. But yes, Fifth Avenue was actually launched a long time ago. It was around for 8 years prior to me joining Barron, and it had a very tough track record over that time. And then Fifth Avenue has a lot of volatility. It's a high risk, high reward fund. It struggled mightily in 2022. It was down a bunch. And so because of volatility, it is considered by Morningstar as riskier. And so that's part of the discrepancy. Durable is much more stable. It is for post-high growth businesses. And it was down a lot less, and now it's up a little more. And so, Morningstar likes that kind of stuff.
Yeah, perfect. Next question.
Hi, good morning. For the Michael in technology, AI is obviously in everyone's buzzword. How do you do your longer-term fundamental analysis of a trend that's just emerging, and how do you identify hype from reality?
Yeah, that's a great question. The first thing I'll talk about is we've been investing in and researching AI for many, many years. A lot of people learned about AI when ChatGPT broke right around Thanksgiving of last year. But we've been working on it for many, many years. We honestly look at the same, fundamental factors that we do with any major trend or certainly technology trend. Those of us on the stage have dealt with, the dawning of the internet, what we call SaaS, software as a service, cloud computing. So we fundamentally believe this is the next generation of computing. I don't have enough time to talk about it in detail. But we do the very same work. We try to become experts in the industries that are impacted by artificial intelligence. At the highest level, those can be semiconductors, software companies, consumer internet companies, mobile application companies, and to try to figure out where we think the long-term value is, as opposed to where we think there might not be significant differentiation. I'll just give you a couple of examples. I mean, we certainly think there's long-term value at the semiconductor, the base layer, with certainly players like NVIDIA. We also have investments in Opportunity and Technology Fund in AMD. At the highest level, we think companies that have touch points with users, one, and two, and this is probably should be the number one, have critical, differentiated, unique data, more importantly, proprietary data. We think Microsoft benefits from not only their relationship with AI, but the fact that they literally touch us almost every single day with our use of Office, and therefore can give us products which they codename Copilot to help us in our daily lives. And they get all the data of those interactions back. One product that Microsoft has is a product that helps developers write code, and they're already seeing a 30 to 40% uplift in that. I'm going to turn it over to my colleagues, but we have many other investments across the market cap spectrum or the development spectrum. We have smaller companies, both in semiconductors, in software. We're thinking about how it's impacting internet businesses, how it's impacting advertising businesses. But fundamentally, it goes back to the classic thing that we do at Barron is the competitive advantage sustainable, or will it be leapfrogged? Just the one last point, when it comes to the LLM, the large language model, there are many of those. We think the development platforms may one day differentiate, but we don't believe the models themselves are going to be the differentiator. I don't know if you guys want to add anything, please.
I'll just add a couple of quick things. First of all, Mike and I have both authored 2 white papers on AI on our website, so I would suggest, if you want to spend a Saturday morning reading those, that those will get you up to speed pretty quickly. Second, I would say that AI is unlike anything I've seen since the advent of either the internet or the PC. It's really an enabler, and you will see AI infuse every industry over the next 10 and 20 years. And we are just so early. We were talking to a Fortune 50 CIO, and he said, if this is a marathon, we're just literally at the starting gate. So it is so early in this journey that, back to your question of how do you separate the hype from reality, what we really focus on, and Mike said it, is competitive advantage. And so the competitive advantages in this business, Mike touched on data, touched on kind of the semiconductor layer and technology differentiators. And I think another big one is distribution. Like if you look at the large mega caps, the Facebooks, called Meta now, the largest companies, they have massive distribution. They reach billions of consumers. Microsoft does that on the enterprise side. So they can take these core technologies and distribute them in a way that very few people can at a very low cost. And they can bring those advantages to bear. So I would just add that.
Alex, you want to add anything on AI?
Yes, I want to give you guys a 30,000 foot view. For better or for worse, we don't do a lot of macro at Barron. We don't take a view on whether terminal interest rates are going to be 5.5, 6, 5. We don't have a view on the price of oil. We don't have a view on geopolitics. But we do have a view on disruptive change. We think that disruptive change has become so pervasive in the 21st century that every company must be evaluated through a disruptive change lens. So when Ashim is talking about AI being part of pretty much everything, right? We think every business model, every competitive advantage has to be evaluated through the disruptive change, and you have to understand whether it will enhance their competitive advantage or disrupt them and basically make them be left behind, right? So we do this for electric, autonomous, shared mobility. We do this for cloud computing. We do this for clean water. We do it for all kinds of possible disruptive changes. And obviously, AI is one of the biggest ones.
Mike, you mentioned NVIDIA, and I know you have Microsoft, Amazon, Tesla, some of your biggest holding. NVIDIA, as of Q3, was your second biggest holding. We've had a big run up this year. What do you think about it going forward from this point forward?
Yeah, well, I wanted to say something about the hype. We have seen this year where companies put out press releases and their stock goes up. We've seen companies make product announcement, not product delivery, and their stock goes up. We've seen on Wall Street counts of how many times the CEO or CFO said AI on their conference calls. As a team, we say we're not going to react to any of that. We want to figure out the reality, and that is just based on all the work that the three of us do with an incredible team of analysts below us. In terms of NVIDIA, we are going through, what they call a platform or architectural shift. The old world, for many, many years, decades, was dominated by what's called the CPU, the central processing unit. The 85% player there is Intel. For a long time, when we were just dealing with PCs, it was Wintel, if everyone remembers that code. We've reached the end of what's called Moore's Law, which is the speed of the processing changing every X number of years. The CPU does what's called serial processing, one process, mathematical equation in a sense after another. Now we're in an era of what we call parallel computing. Some call it accelerated computing, dominated by a chip called the GPU, graphics processing unit. It's only called that because the first application was in video graphics, mostly computer games. We visited NVIDIA and Jensen, all three of us, with others, 2017, 2018. We spent the entire day talking about artificial intelligence, how many years before ChatGPT came on, because Jensen was planning for this day. A key differentiator for NVIDIA, and very important, is not just the chip itself, but it's the software and ecosystem architecture built around that. Like the CPU called x86 dominated because everybody wrote code in a sense to that platform. We believe NVIDIA will be a dominant player in the future. When we think about where we are today, as Ashim said, we're just like almost in warm-ups. The size of that market is tremendous. You have the CEO of AMD talking about a 50% CAGR, compound annual growth rate, in accelerated computing chips for the next 5 years. When we model NVIDIA, I think pretty conservatively as the amount of share that they can get in this massive change, amount of profits they could generate, even today with this year's move. And this year's move is not hype. Look at the numbers on NVIDIA. I've never seen numbers like that in my career. But when we model out NVIDIA today and put a very reasonable multiple on it, we still see double-digit, significant double-digit multi-year returns. So that's why we're still big investors there.
All right, perfect, thanks. Audience question? Right over here.
To follow up on your question, or the last question about the artificial intelligence, do you envision a day when you will have artificial intelligence running these mutual funds, or you will have far fewer managers?
Alex, we'd like you to answer that one. I'll be happy to say something, but I just talked, so why don't you talk, my friend?
This panel will be just a blank table next.
There were a couple of buttons behind Frank that were checking out, before this started. I don't know. I think it's possible. I think it is unlikely. For now, we still can't figure out autonomous driving, right? We got it to 3.9 reliability, right? So 99.9% reliable. We need to get it to 5 nines or 6 nines. Some of you may have heard of the incident that Cruise had very recently, GM Cruise, in San Francisco, where the robot did not behave the way a human being would have, right? And so I think if it is possible, we're years away from that. It's still, if then, these are still basically large algorithms. I mean, Tesla is doing something that I think is really interesting, and it's something that we need to watch. But certainly, robo-advisors are not a threat to real financial advisors, in my opinion. So I can't really see AI doing what I do. I don't know about you guys.
Yeah, the only thing I'll say is, there's lots of flavors of investing, as all of you know. Even today, there's, as Alex said, algorithmic trading. You could invest in a shop that does algo trading, and algo trading's been around for at least a decade. It's a form of AI because it's using data and intelligence to make decisions and prediction about the movements of stocks or other securities. I absolutely think there will be plenty of AI funds, and one could decide whether or not to invest in them, and you'll be able to look at their performance against human beings. I do believe in our business in lots of different ways. We will be utilizing AI, whether it's to help first drafts of writing, whether it's summaries of research, summaries of transcripts, highlighting major points from things like securities filing. So I do think AI will become infused in our business and honestly at Barron Capital make us more productive in our jobs. Like Alex, I think it'll be many, many years before you're looking at the stage and you're talking to a computer. I think you'll still be talking to us humans for a while longer.
And we
I
did
would
get...
just add one more thing. I think Barron is known for having a long-term view and being able to hold stocks. I'm not sure, the basis of what AI is based on is data, and that data is constantly changing. And just like we have thoughts every day, every minute about an opinion about something that changes, but do we act on it? And I think an AI-based fund might be something that's very trading intense and not tax efficient and is not the ethos of what we do, first of all. And the second thing I would say, exactly what Mike said, is that this idea of a co-pilot, I'm using that term loosely, but everyone in this audience is going to be interacting with some form of agent. Today, it may be Alexa or Google Home or whatever it is that you interact with, Siri, but you're going to have more of these agents in your life, and they're going to be able to do more and more for you. And in the enterprise, Microsoft is going to have them. Every piece of software you interact with is going to have this agent. When you book travel in the future, you're going to have an interactive agent. And they're just going to be people who are going to make you better at your job and more efficient. And so I believe we will have that, and I believe every industry, every IT worker, knowledge worker will have that.
I think, just to finish up, I think it's going to come down to your time horizon. I think AI can definitely trade it, right? So if the competition is trading, AI will beat all of us. It's unclear to me that AI can own it, that AI can evaluate long-term prospects, durability of growth, talent, competitive advantage, sustainability, duration, all of those things. That's far more complicated.
And we had the question last night at a little event last night about AI, how does it affect financial services, which means on the advisory side and on the asset management side. So I think it is something that's going to be a big impact, over time. So next audience question over here.
Oh, thank you. Good morning. For Alex, what have been some of the key drivers to outperformance this year in the Fifth Avenue growth compared to the couple years of underperformance the past few years, and what will be the challenges and opportunities of beating your benchmark going forward? And for Mike and Ashim, your two funds look very similar. What is the holdings overlap, and what are the key distinctions between the two? Thank you.
Alex.
So it may or may not come as a surprise, but a driver of performance is frequently past performance. And what I mean is that your prospective returns are always negatively correlated to your current and recent ones. So we've had a massive run in the stock market, in returns, and in Fifth Avenue's performance in years 2018, 2019, 2020, right? We CAGR'd, I think, around 35, 36%. So what that meant to me is that your prospective returns clearly did not look as attractive. Right? Obviously, 2022 was a watershed year, meaning we had an unprecedented Federal Reserve move where interest rates went from basically zero in late 2021 to 5%, call it 18 months later. Right? You can't have a move like that without breaking something. And so 2022 was a very challenging year. And then, you look at 2023, part of the reason why 2023 is so good is because many things got broken in 2022. And so you look at some of our best performers, Amazon. Amazon was down 40% in 2022, and it was up, 50 or 60% in 2023, right? Large cap, obviously, Magnificent Seven, right? We always have these new things. There's FANGs, there's FANG Mangs, whatever the heck they are, right? So Magnificent Seven has been driving returns, and I think we've owned 5 off the 7 in Fifth Avenue, and that's been a big part.
I'm going to give it to you at the high level. We can go in a lot of depth. We've been investing, broadly in technology trends for 20 plus years at Barron. I've been there for 22 years. Alex and I in our funds, honestly helped by Ashim as one of the key analysts for over a decade, have put a very good lifetime performance. Fifth Avenue is a large cap fund. Global is obviously what it is. Barron Opportunity Fund by prospectus is all cap, and so different Morningstar and others who look at it, sometimes it's in the large cap bucket and sometimes it's in the all cap bucket. We didn't have a product in the technology bucket, and there was a massive opportunity. We did a study of all of our funds and said, if we were going to do a technology fund as we define it, meaning predominantly information technology, call it 65% above that sector, as well as e-commerce, digital media, digital advertising that GICS puts in other sectors, but we really consider technology companies, electric vehicles as well. What would those funds look like? And the performance was honestly excellent. And so the decision made by Barron, Ashim and I in conjunction with Ron and Linda, of course, was to launch a technology fund that is really focused on that space, would be recognized by all the others in the world as a technology fund, and allow our investors to make the judgment, do they want a pure technology fund, or do they want Global Advantage, Fifth Avenue, or Barron Opportunity Fund? The overlap is probably 80% plus. We do the same work, we look at the same stocks. They are not exactly the same. We are certainly more concentrated in the areas, for example, of semiconductors, software, in the technology fund than we are in Opportunity, Fifth Avenue, or others. And Ashim, please add anything if you'd like.
I think you said it well. I would just add that technology broadly has compounded at roughly 17% over the last 10 years and 16% over the last 20 years. If you look at semiconductors, as in the semiconductor benchmark, it's compounded at 23%. Semiconductors make up a third of the technology fund. Semiconductors, if what coal was to the industrial evolution, I believe semiconductors are to our current digital revolution. So semiconductors are the digital oil. I mean, they are at the basis of everything we do. And quite candidly, I think it's helped all our funds also just to have a bigger semiconductor. We've really built up our expertise. We have 2 fantastic analysts who help us every day, David Sobel and Eitan. And so we are able to invest more heavily through this fund, not only purely on the secular, the best performing subsector in the S&P over the last 10 and 20 years, but also research and surface those ideas across all our funds. So it's been a real, I think, blessing internally for us as well.
Alex, you gentleman asked about a couple of your funds. Durable Advantage is a little bit different. It's probably your lesser known fund, a smaller fund. It's been around 6 years. It's beaten the index, the 135 since inception, and it's a 5-star Morningstar rated fund. You also have a little bit different profile. You can't reinvest the capital like you can in some of your other funds. They return money to shareholders. So how do you talk about Durable different than you do the other funds? Or how do you think about Durable?
So we have 3 different strategies, right? Guy and I manage Global, Fifth Avenue, which is large cap, and then Durable. The underlying idea is to have a home for high quality businesses. If that business happens to be outside of US, then Global is the home. If that business happens to be, US large cap, then Fifth Avenue is. And if the company happens to be post high growth, then Durable is the place. So Barron, by reputation, by its history, has always been a growth investor, right? Growth mindset has really been fundamental to the philosophy and process of the firm. And so at some point in 2017 or 18, I went to Ron and said, look, At some point, growth is going to be out of favor, right? And we're going to have shareholders that are going to say, look, every fund you guys have is a growth fund, right? What if we're nervous? What if we're closer to retirement? What if we want something that is a little bit less high octane, right? And that's how the idea of durable kind of came about. So these are still competitively advantaged businesses. These are leaders in their space. But these are the companies that no longer have the ability to reinvest capital at high rates of return because their industries are more mature, because they're further along in their penetration rates, because it's more consolidated, whatever it may be. And so they do pay dividends or they buy back stocks, and this is a lower risk, lower return fund, if you will. And of course, until 2021, no one had any interest in it because it was all about high growth, right? And then all of a sudden in 2022, people look at it and they say, wait a second, it's down a lot less, and it has these high quality businesses, and you got Microsoft, and you got United Healthcare, and you got Arch Capital, and you got credit cards, and Moody's, and right? Like these are good businesses that can compound at 10, 12, 15% for really long periods of time, and they have very high current free cash flow yields, and they have really high returns on invested capital. And it kind of makes sense. And so you look over the full cycle, and it went down less in 2022, it's up more in 2023, and now it's a little bit popular, and and Morningstar knows what kind of helps make it popular, I guess. So
I guess that answers your question again as well.
That's
audience question.
In the front.
Thanks for letting me ask a question. I just wanted to follow up, sorry not to beat a dead horse, but on the AI point. I was just curious to hear, I think you guys do a really good job of focusing on the long-term outlook for these types of trends. But what's interesting is right now, companies are spending like $300,000 on these AI servers for training clusters, right? The way I understand it is like you spend a lot of that money to train things up front. You can see CapEx basically like short-term explode for like a company like Microsoft. But longer term, that has to be justified with monetization, obviously. So I'm curious how you guys think about what the long-term picture of the hardware piece looks like on the server side. Is there a blend of perhaps 80% servers being traditional CPU-based and 20% being, AI GPU-based? I'm just curious how you guys think about that balance of spending versus monetizing over the long term.
Yeah, so when you think about AI, there are, of course, many, many pieces of it. You mentioned training. You have to train the model in order for the model to give the answers, which is known by the term inference. The model can't just be trained once. OpenAI had a developer day today, and they're already out with their newest or latest model. And they also have other technology ways for continuing to update the model, because if you've trained the model, I don't know, to a year ago, it's going to be behind the times. So we do believe that training, what they call fine-tuning, reinforcement learning based on human interactions, all of these things will continue to happen. And in our view, there's no doubt that GPUs and what those evolve into, these accelerated computing chips, will continue to be the workhorse chip for training. When it comes to the other part, inference, our daily interactions with AI, as Ashim said, we're probably going to interact daily, multiple times a day with an AI agent or an AI bot. We think there'll be multiple, kind of underlying infrastructure for empowering that. Based on our research today, we think most of it will be GPUs. There may certainly be different GPUs that are used for training already. NVIDIA has differentiated products. AMD is rolling out their product, which is really focused on the inference market. We've talked to plenty of CEOs who think that the inference side will be much, much larger than the training side. So we still think there's going to be a lot of evolution. We think the market size for accelerated computing chips is massive. I gave you that number. I think it's 150 million is projected by many by 2027, which gives you a CAGR of 50%. We think, on the other hand, the CPU world will continue to grow, but will probably grow in the single-digit rate. And I want to be clear, like we look at the estimates made by lots of sell-side firms. We certainly talk to all of the companies involved to make a sense of whether or not we see these estimates as accurate. But most importantly for us is, rather than trying to model out exactly what we think the size will be for a given industry, how much chips will be CPUs versus GPUs or other things, we look at our individual companies and we think about what the impact will be. And I'm just going to end here, but you're right. The critical thing will be monetization. I can't tell you how much work we've been doing on how AI will be monetized, whether it's a Microsoft Copilot, whether it's what other companies are doing. For example, ServiceNow, which they call the Pro Plus SKU, which will have AI embedded in it, and they're looking to make about 25% more in the average selling price of that SKU versus the non-AI. And if I turn these guys over, I'm sure we could give you lots and lots of examples of monetization, but we're spending a lot of time on that to make sure that these investments are justified and have a good return on capital, because if they don't, people won't continue to make the investments. I agree with you.
I just want to give, everyone here may not know what training is and inference is, so I just want to give you a very simple analogy in AI. Think of it as a child. When you're teaching a child, that's training. You're giving them the data, and then they're forming in their brain the interconnections between different words. When you're inferencing, you're asking that child, you're querying them, you're asking them questions. So when we're talking about models and training them, we're teaching these AI models, and we're giving them data, and they are forming correlations. When we are then inferencing, which we will do a lot more, so every time we're talking about these co-pilots earlier, these agents, the Siri and so on, that is inferencing. So every time you ask, so there will be vastly more usage of inferencing. And certain types of chipsets, AMD, so memory is one of the things which will matter more in inferencing, because let's say you're talking to this agent, let's assume it's travel, and you're saying, hey, I want to go here, and you don't want to re-enter your travel dates. You just told them when you're going. Said, hey, use the same travel dates. So that requires more and more memory. So as you have longer interactions, you need more memory. So inference will be much more memory intensive and will require you to also interact with these, will require a lot, to your point about servers, you will require a lot more. It's not clear. If these are very small models, you can get away with maybe CPUs. But as the models get bigger, medium, the number of parameters increase, that's where you start using GPUs. So the majority at scale will be GPUs. But there may be, you might have a laptop, and AMD is already talking about AI CPUs, which means they will put AI on the actual CPU, or your iPhone, because you're going to need more and more of this inference closer to where you are. So your iPhone today does, will not have that capability, but the next generation, the generation after that, will have much more capability. So more of this is going to come to what we call the edge for inferencing. I hope that answers the question.
We all have an investment in a company called Cloudflare. I know you want to talk about it, which is literally building out a network and an infrastructure for inference at the edge. Go ahead. If you, I don't know where you want to jump. Yeah.
No, we all can't help ourselves. We all want to. Just to close the question with CapEx and hype versus fiction. So Microsoft reported their earnings a couple of weeks ago, and they reported $500 million of new AI revenues. This is one company, one quarter, right? In terms of monetization and getting return on your CapEx, $500 million of new AI revenues coming in the most recent quarter just for Microsoft. So, yeah.
Good, thanks. Next question. Gentleman or over here.
Yeah, I was wondering if you, after reviewing 22, if you had any lessons learned you could share with us.
All right.
The answer is, of course, yes. I fundamentally believe, and all the people that I work with, that in a sense we want to be AI. We constantly want to learn from new data. We want to be not continuous improvement people. So at the end of every single year, I do an annual review, whether it's a great year or it's a bad year. As Alex said, earlier on, and this is true, and Ron has written about it for 40 years. We do not try to, frame or model, predict interest rates, global wars, what the Fed is going to do. I do think what happened in 2022 was a perfect storm that will not happen very often. Why? We had, a once every half century, 50 years, increase in interest rates. We also had, and I could get in a lot of detail about that, grab me on the side if you want more detail. We had a breakout of the first war in Europe that, no one anticipated. What I've learned is, while I think it is very, very hard to kind of trade the market, and therefore we eschew trading, we really think about long-term investing as going from point A to point B, where there might be some choppy waters. I've written in my quarterly letters, and I love it, Warren Buffett or his mentor, Benjamin Graham, in the short term, the market is a voting machine. In the long term, it's a weighing machine. I think about that weighing machine model all the time, because what do we want to invest in? We're growth investors. Even durable growth. Companies that are just going to grow what I call faster for longer, that's my tagline, and they're going to gain weight, and you're going to put the weight of their earnings or cash flow and balance sheet on a scale, and that's going to be what it is. I will simply say that when you get at extremes in the market may react in a significant way. And for myself and my funds, it wasn't lost on me at the end of, 2021 that we were in extremes coming out of the pandemic in where valuations were. And I didn't want to completely change the stripes of my portfolio, but I did a number of things to lessen the weight of earlier stage companies without as much free cash flow, earnings, balance sheet, to lessen the ones that were, some of them were trading at 20, 30, 40 multiples, not of earnings, of sales. And some of them I exited out of my portfolio. When I look back, I did a lot of the right things. I just didn't do enough. Now, I think in a normal up and down market, you don't want to do those things, but sometimes there are extremes, and when you notice that you're at an extreme, I've learned that you might have to do more. So that's one of my learnings, and I'll let my colleagues share if they want to say anything.
Go ahead. I mean, I wouldn't add anything other than I would highlight that last part Mike said, that I think we've all made our learnings from that, and there were companies that were just at exuberant valuations.
Okay, perfect.
I don't know that we have enough time for me to cover all the lessons that I have learned 2020. But I'll tell you this. This is a humbling business. Markets will humble you. And just when you think you have it figured out, right? Just when you build yourself up, and just when you have this lovely 3-year, 5-year, however many, 25-year track record, the more you think you know, the harder you're going to get hit. That's my first lesson. Lesson number 2, and this may be controversial and not everyone at Barron will share it, but I think private investments suck. I think mutual funds are not the best place or home for investing in private companies. I'm not sure that we necessarily have the skill set or the right, clients, right? There's a reason why VC funds have lockups and, long duration and all those things. So, investing in private, certainly in our global fund, we got absolutely decimated, by privates. And then the other lesson learned is, don't go running too many funds, because there's absolutely no way that all of them are going to do well at the same time. So there's always something. So we have 2 funds that are doing well, and we have global fund that is not doing so well. And it's like having children, right? You're always focused on the one that's not doing well, right? The ones that are doing well kind of don't matter because they're doing well. But the one that's struggling kind of sucks out all of your energy and attention and emotion, and it's just hard. So maybe, stick to 2 funds if you're going to do it.
With that, I think we're...
if I can. I mean, we have to end now. We're running out of time. I see my colleagues coming in. We're the first panel of the day. You're going to see lots of great panelists. If you have questions, find us during the day. Please walk up to any of us and all my colleagues anytime. There's a lot more depth. We can go into AI, thinking about investing, any topic. So I just invite everybody here, at some point if you have a question, just reach out to one of the Barron portfolio managers or analysts, please.
And I think we could have gone hours on this, but thank you all very much again for being the first participants. Have a great conference.